Hello, everyone, and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me in the studio is my friend and colleague, Niklas Sävås. In today's episode, we will speak to an experienced investor who has selected a superb book to discuss with us. And this is a format we find interesting to mix with the pure author interviews that we're usually doing. So, Niklas, who is our guest?
So the person we have invited this time is Todd Wenning, an American investor and writer with a background including Ensemble Capital, Motley Fool, and Morningstar. In episode 5, we actually came across some of Todd's work since he's a contributing author to the book Why Moats Matter.
The book for this episode is Lessons from the Titans, with the subtitle, What Companies in the New Economy Can Learn from the Great Industrial Giants to Drive Sustainable Success. The book is written by Scott Davis, Carter Copeland, and Rob Wertheimer. It was first published by McGraw-Hill in 2020. Here comes our conversation with Todd Wenning. Hello, Todd, and welcome to Investing by the Books podcast.
Thanks for having me. This is great.
We met briefly in Omaha last year, and this time Niklas and I are in the studio of Redeye here in Stockholm. But where are we reaching you today?
I'm based in Cincinnati, Ohio, which is probably about 5 hours drive southeast from Chicago. If just trying to get a mental picture of the United States map, we're bordering Kentucky and Indiana, so we're right in the Midwest, right at the beginning of the Midwest as you head west towards Omaha.
And is it in the home office or where are you?
Yes, I'm currently in my home office.
And for those not familiar with Todd Wenning, can you tell us how your interest in business and investing started?
Sure. So a friend of mine suggested I apply to a company called Vanguard, which I frankly had never heard of before. Vanguard is based in Valley Forge, which is out west from Philadelphia, but not too far. And I was hired to be what they call a registered representative, which is pretty much an entry level licensed broker, so to say, where I was able to place mutual fund trades for customers and talk about the mutual funds. But I had really no idea what I was doing. I remember when I got the study guide for Series 6, I didn't know what a stock was. I think Vanguard hired me because I had a great undergraduate GPA and I had experience on the phones. And so it was really learning on the go. They took a big chance on me. Hopefully I lived up to it for them. But as soon as I got the Series 6 book and started studying, I thought this stuff is just absolutely fascinating. And coming from a liberal arts background, all of the different factors that play into investing just sort of lit up in me. So being able to integrate everything from philosophy to art to economics, and incorporate that into your investing approach and how do you think about business, that really resonated with me. And so it just went from there. So I was at Vanguard for 2 years. I started out in the mutual fund space and then moved up to the brokerage department where I was trading stocks for clients, placing orders, things like that. Got the Series 7. I'll summarize where I've been since then. You asked me where I got started, and you can stop me at any point and ask me about different experiences. But I went to what was called SunTrust Asset Management, which is now part of Truist Bank in DC, Washington DC. My girlfriend at the time, was down in Virginia. She had just graduated from college, and I ended up moving down there. Was helping a lot of portfolio managers work with high net worth portfolios. And I happened to live about 3 miles from the Motley Fool headquarters in Alexandria, Virginia. And they had a job opening for a financial editor. And I've always liked to write. And I had a couple of years under my belt as an investor. And I went to the Motley Fool, and it was 180 degrees difference in terms of culture from a bank. It went from, button up, suit and tie every day to wearing flip flops and shorts to work. And we had a game room. We had peanut butter and jelly day. It was, the complete opposite of a bank. And it was just the amazing place for a 25-year-old to work. And, they really gave us the keys to the car, so to say, so we could write on the website. And that was just such an accelerant to my learning experience. And there have been some tremendous investors that came through the Motley Fool system. Most notably Morgan Housel, the most famous of us, to come out. And so he's obviously done a great job with all of his work. But Motley Fool was a tremendous experience. I worked on the newsletters there. Moved to London for a year. Worked on Motley Fool Dividend Edge, and I got to the point where I really wanted to become more of an institutional investor. And the Motley Fool is great with the retail crowd. Institutional, it's a little more challenging to move into that space. So I decided to move more institutional, and Morningstar was a great way for that to happen. So a lot of Motley Fool people had gone to Morningstar at various times, and so there was already that established bridge. And Morningstar was ramping up its institutional equity research group, and I was covering the paper and packaging industry, and I was leading the equity stewardship methodology, which looked at how management teams allocated capital, and how it reinforced or detracted from the economic moat. Around 20 in 2014, my youngest son was born, and my oldest son was born, my only son was born, my first kid. And so we moved down to Cincinnati, where my family is based, in Ohio. I found a buy-side job working with Johnson Investment Counsel in Cincinnati, and was working on their SMID cap portfolio as a generalist analyst. I eventually moved to Ensemble Capital in a fully remote setting, working out of Cincinnati for Ensemble, which is based in San Francisco. And here I am now. I'm working on the Flyover stocks newsletter on Substack, where I'm looking for companies with economic moats led by thoughtful leaders of shareholder capital.
I'm curious to know what influence Pat Dorsey had on you in terms of your moat framework.
Yeah, so I'd never worked directly with Pat. He had gone on to his next roles before I had gotten there, but he certainly influenced. His books and his methodology are the cornerstone of the Morningstar approach. The five sources of economic moat, how to think about competitive advantage, and so it was certainly an influence. And I very much admire Pat. I don't know him well. We've met each other a couple of times, but I don't know him well. But I've certainly learned a lot from him.
I'm also curious to hear more about your interest in history.
Yeah, so I've always been interested in history, even as a kid. I just been in Cincinnati. It's a very historical city, which is not well known. It's given the comparison between European history and American history. American history is very young, but Cincinnati has a lot of history going back. The city was founded in 1788. It was the first boom town in the West. Well, at the time, it was called the West, but it was west of the Allegheny Mountains. It was the first major city. It was a major economic hub. There was a ton of money came to Cincinnati. I'm sure we'll talk about this later, perhaps, but Procter and Gamble was founded here, and it was because it was on the canal system that had just been established, and that allowed them to get their products coast to coast and around the world. And so Cincinnati's got a lot of great history. And I remember going to different parts of the town with my dad growing up and just being fascinated by, seeing what had come before. And so I just really excelled in that as a student. As a kid, I had some great teachers over the years, which always helps, and just, made history come alive. And this certainly at that place, just this amazing resource for investors, and I'll say not so much when you get started, because if you're going to apply for jobs in the finance world, they see history degree, they see, oh, this guy's a project, right? This is going to take a long time to teach him all this stuff. But certainly as you get into the investing world and you take on more responsibility and have more of an opportunity to see things from a 10,000 foot view, the history major really comes into play. I mean, it's the disciplines that you learn. It's how to research, how to write, how to communicate, how to piece together disparate pieces of information and tie them together into a thesis. Those are the disciplines that you learn in the history and in university, especially. And so there's a lot of great portfolio managers out there who were history majors. I can name a couple off the top of my head. I mean, just they came from just a liberal arts background and had a very similar path to me, where they got into the field, and they were able to apply those, what I'll call soft skills and qualitative skills over time, and it's helped them allocate capital and think about, this is what's happened in the past, and this is what's likely to happen in the future. And obviously, the future is much harder to predict than looking backwards. But certainly you can spot trends and themes over time, and that can help inform your investing approach for sure.
I think the book we will speak about today is an example of that. We would speak about Lessons from the Titans. Why have you chosen this book?
I read this book, Lessons from the Titans, on a flight out to California earlier this past year, and it just everything seemed to strike a chord with me. You can call it confirmation bias, perhaps, but as I was reading, I thought, this is something that I wish I had written. It's just the way they approach things. The authors did a great job of laying out why certain industrial companies, which were the tech companies of their day in the 60s, had succeeded through the next 50 years, and others had failed. I think they did a great job tying together some key themes related to having systems in place, having a great corporate culture, and what that actually means, and how management teams should operate. And I think it's a great lesson for investors, especially long-term investors, people who are wanting to own businesses for ideally decades, to really come to appreciate what that takes, because companies are not static assets. And that's something that's really resonated with me in the past couple of years. Is there's a school of thought that you buy stock and you hold it, and you just hold it indefinitely and you never touch it. But the company that you bought 10 years ago is different from the company that you have now. If you had to start from scratch, the company that you're buying now or you're holding is different. So I do think that you have to continuously monitor your companies and figure out, do I still want to own this? And so it's always a tricky balance of trying to figure out, is this a company that I still want to own, or are there concerning signs that things are starting to deteriorate? And so I think this book does help you think through some of those those trends within the business cycle and a company's life cycle.
And the authors of the book were, at the time of publication, all principals at Milius Research. Can you tell us a bit about them?
I don't know them very well, but I know that they covered the industrial sector for quite some time. So they had experience speaking with managers in the space over 10 plus years, and you do start to pick up different trends within the business cycle and the industrial and the company life cycle. And they flagged up some of the really important factors that they had learned over time in following these companies. And so I thought they did a great job incorporating all these things together.
And for those who have not read the book, it consists of 10 different companies that are included, which usually comprises of one chapter of each company. Only General Electric is big enough to have 2 chapters dedicated to them. But it's success stories, there are crisis stories, and there's everything in between. And one of the companies mentioned is Honeywell. And for those not familiar with them, maybe you can introduce our listeners to the company.
Yeah, so Honeywell started out, I believe, as a thermostat company, and it grew into a industrial conglomerate over time. And the story that I really liked from Honeywell was the profile of Dave Coate, who was the CEO, I believe, starting right after the dot-com bust around that time. And just his stewardship mentality is something that uh, I wish I had understood at the time. This would have been early in my investing career, starting in 2003. But it was, that example provided a great blueprint for the type of CEO that you should want to back. Because one of his quotes from the book, which they shared, is, "I want to make money in the stock 10 years after I retire," which I think is an amazing perspective. And if you heard that quote, you might think, "Oh, he said that towards the end of his career." No, he said that in the beginning of his career as the CEO of Honeywell. So he was already thinking about the long term and what that meant 10, 20, 30 years after, from that point forward. And that's a different mentality than what we hear from a lot of CEOs out there. Most of them are not thinking with the stewardship mentality. most of them are trying to maximize the profits and maximize the share price, which on paper sounds like a great thing. But as an investor who wants to own a company for 10 plus years, you're aware that you're probably going to own the company through multiple managerial cycles. The average tenure of a CEO in the United States is, I think, 4 or 5 years. So we don't really want to own companies where the CEO is going to turn over that quickly. But even with a CEO, if they have 10, 15 years, that puts them in the upper echelon of tenure. And so if you're going to want to own a company for a long term, you're going to have to go through different managerial cycles. And so you really want to have a CEO who is setting the company up for long-term success, not just maximizing short-term profits and then dealing with the collateral damage on the opposite side, once they retire. And that does happen quite a bit in the book Profiles GE, for example. They talk about how when Jack Welch left, everything seemed to fall apart. And to me, that's not a good look for Jack Welch. That he's frequently held up as one of the best CEOs of all time. I have no doubt that he was an excellent CEO, but from a stewardship approach, it's very disconcerting when you hear about what happened to GE after he left. Certainly, Jeff Immelt, as the book discusses, played a role in that, but it seems like the corporate culture at GE at the time was not great, and that's not a good look for someone who's stewarding the business. As compared to Dave Coate at Honeywell, the company has gone on to do very well since he retired. And so I think that speaks very highly of his approach. And one of the other quotes they talked about with Dave Coate in Honeywell was, he wanted the sort of standard to be that other companies want to poach their leadership from Honeywell because they're the best leaders, but the leaders want to stay at Honeywell because it's even better than if they had gone somewhere else. And so those are sort of quotes. If you hear something like that from one of the companies that you're researching, that's just a gold mark right there. That's a fantastic thing to hear, and you should get excited about that when you hear it.
And if we're staying with Honeywell there for a little moment, I mean, one thing that Dave Coate did was that he was paying top performers, not just for the job they were doing today, but also for the job that they will be offered tomorrow. I think that was quite striking as well. What are your thoughts on that?
Yeah, that's certainly something that is difficult, I imagine, to justify in a boardroom or in with a budgeting team that you have, is saying, if you have a guy who's making $100,000 in his role, and you're saying, well, I want to pay him for the next roll up and pay him another $30,000 a year just because, that's a hard thing to justify, I'm sure, when it comes to budgeting. But that's one of those intangibles that is very hard to replicate. So Costco, very similarly, was frequently blamed by analysts for overpaying their work staff and paying their benefits, giving way too good healthcare. If you look at some of the sell side notes from the 2000s, that was the constant concern, was that Costco was overpaying, and similar to Honeywell. And what that did, though, is it created this longer term value creation, because you have less turnover, which takes cost out of HR, takes cost out of having to constantly put new people into the system, which are real costs. It's just very much harder to quantify. And so I think that's probably the shared perspective that Jim Sinegal from Costco and Dave Coate from Honeywell had, was we want to pay people as if they're going to stay here for the rest of their career, and we don't want them to leave because they got another $5,000, $10,000 for their position, so somewhere else. So that just makes a ton of sense. We're thinking long term, but I can see why analysts and outside analysts and investors might be frustrated with that, saying, hey, we could get a couple more points of margin if you just paid everybody what they were worth. But longer term, it creates this virtuous benefit that I think is overlooked.
Roper and Danaher are two other success stories described in the book, and both of these and also other examples that we have described explain the need to have strong systems in place and a laser focus on capital allocation and cash flows. So if we start with Danaher, can you talk about Danaher business system and what made it successful?
Yeah, Danaher Business System was really a fantastic application of lean systems that they incorporated from a lot of the Japanese manufacturers like Toyota, and they brought it to the U.S. and really started applying it across all of their acquisitions and across all the businesses that they had acquired, the Rails brothers. And I think that just drove home the value of this lean mentality, and it's replicable. It can be systematically applied, and Danaher Business System is become the gold standard. I think pretty much every other operating system across industrial companies now tries to mimic the Danaher Business System, and that's one of the things I think is a challenge now, is that pretty much every industrial company has their own system. So then it becomes, okay, how do you tell which ones are actually working and which ones are not working? And but the Danaher system is interesting because it allows them to almost pivot when they don't see the value in the system anymore. So the old Danaher is now Fortive, which is a separate company, and Danaher now is much more tied to healthcare. So that's a very rare type of business that is able to let go of these legacy systems when they don't think that that's where shareholders want to have value anymore or see value anymore, or at least it's taking a different approach. I mean, most companies would hang on to those legacy assets because those are people that those are people that have been part of your business for a very long time, and it's very difficult behaviorally to do that. And so I think the Danaher approach is unique. I don't think that most companies could replicate it in that way, but it's just a fantastic process, a fantastic system that I think everybody should learn about. And this book does a great job explaining it.
And just go into a bit of a detail look into that. I mean, it could be like things like output per employee, and I mean that the company delivers on time and so on. I mean, a lot of different metrics, of course. And for investors, I'm just curious to know, as you said, I mean, many of industrials have these systems now, but for investors, how do you really understand and get the information on that, because it's not all that really describes these metrics in the reports and so on. So how do you go about measuring, I mean, the progress in terms of that?
Yeah, that's a good question. It's challenging. I think that you have to really understand how the system uh, plugs into the moat. That's how I would approach it, is thinking about, okay, how does the system make the moat stronger? I think I'd have the same approach with culture. It's companies talk about, oh, we've got great corporate culture. That's great, but how does it impact the moat ultimately? There's a company based in Wales called Admiral Group, which is an insurance company that I've owned personally for over 10 years. And I remember going out to Cardiff and meeting them, and one of their core advantages is this super low expense ratio. They have the costs down to as low as they can possibly go. And I got to see it firsthand. They were not ornate. There was nothing ornate about it. Everything was very basic. And when they opened up a U.S. office in Richmond, Virginia, this was in probably 2009, to teach the U.S. People who work there the culture. One of the things that they did was they had a printer put outside of the CEO's desk in Richmond, and if you wanted to print something on paper, you had to go in front of the CEO's desk and do a push-up for every piece of paper that you wanted to do. And so I think that to me is an example of how the culture can translate into supporting the moat. And so thinking about the systems the same way. I mean, pretty much all the systems talk about, okay, we're gonna focus on companies that have, on an acquisition perspective, looking at a wide spread between gross profit margin and operating margin. Because if we can acquire those companies, we can take out a lot of the operating expenses and create a lot of value for our shareholders. And so I think that it's the replication and the track record. So if you are not seeing results from that approach, I think you have to ask questions. Okay, why are returns on invested capital declining in this? Are you overpaying? What's happening with your acquisition process? Why aren't you able to take more cost out? What's going on? Why aren't things working the way that you expected? So I think, and that takes time. That takes time in monitoring. So if a company came out and launched a new system today, it's probably going to be a couple of years before we can really get a sense of whether or not the system's working. And so that's where I think you need to put your qualitative assessment hat on and look at the culture and work with management and try to understand, if they're serious people. Like if this is just a way to satiate Wall Street or the market, that's not what you want. Obviously, there should be some sort of intrinsic motivation beyond just getting this done. There should be something about creating shareholder value, creating great businesses, enjoying the prosperity that it brings. Those are all part of the intrinsic motivation. So then you can look at things like incentives. Okay, is management, are the incentives aligned with what the system is trying to create? And if they're, for example, if they're looking at revenue growth and the system's supposed to create operating profits, well, that's maybe a mismatch. And you have to think about, okay, well, why are you incentivizing management on revenue when you're trying to drive OpEx reductions? So these are all things that I think you should be thinking about. But that's the first time I've thought about that question. So it's hopefully that answer was probably circuitous, but got to what you were looking for.
And speaking about the Danaher business system, one thing that I took away from the book was speaking about growth, and that the optimal growth is about 4 to 6% on top line, and not less and not so much more either, which is quite uncommon. I mean, we often look for disruptive high growth companies, especially in the last couple of years. People have been desperate for that. So what are your thoughts on that, and why is that?
Yeah, I thought that was a great point that the authors made in the book, and they're right. It's a machine, and if you are overfeeding the machine, it's going to burn out, and if you're underfeeding it, you have poor utilization, right? And so that's how I would think about it. I've often used the illustration for returns on invested capital, where it's like a machine, and you have invested capital. Let's say it's $100, and you put it in the machine. And if it gives you 20% returns on invested capital, you get your $100 back, another 20, but that comes at a cost, right? So you have to pay, like, let's say 8% for the cost of using that machine. And so if you're overfeeding it, like, that produces a lot, but it could also produce declining returns over time. So I think the machine has to be able to take all the capital that's coming at it. Otherwise, you're going to have incrementally poor returns on invested capital, which is not what you want. And so the other thing is, if it's growing that fast, if the input's coming in so much more than it can take, that means you have to scale up your employee count and scale up your investments, and that also leads to declining on returns on invested capital. So I think that's interesting, because you're right. We do sort of lionize these high growth companies, and that's, I would say, more reflective of an intangible asset business that can handle it. So when you have a capital light business, you can handle more of that. But when you have a capital intensive business, like these manufacturing companies, you can't handle that growth. It's much, much harder to do it. And so that also leads to these companies flying under the radar, which is one of the things I like to look for at Flyover stocks in my newsletter, is trying to find these companies that are growing, just not double digits and not attracting a lot of attention. But if that's a durable growth rate, I mean, if you're growing 6% a year, you're growing faster than the economy. And over time, that compounds. That 6% year after year after year compounds. And so that's a very attractive type of business that will fly under the radar, and probably makes for a very attractive investment, depending on what's happening at various points in the cycle.
And one steady compounder is Roper, which is a company depicted in one of the chapters here. And this company really resembles some of the successful serial acquirers that we have here in Sweden, with a repeatable business model and using these strong growing cash flows to buy more and more companies. So, I mean, and also Danaher is an example of one with a similar model. So, but this has also been developing a lot over time, and that's something you spoke about in the beginning, how this evolves. So maybe you can say a bit more about Roper and how this happened over time that they developed.
Yeah, Roper developed, Brian Jellison developed this approach called CRI, cash return on investment, which is very similar to the definition that I use of return on invested capital, which is NOPAT over invested capital. He makes a couple of different adjustments in there to make it more sort of cash on cash sort of returns. And he really, I mean, Roper, we used to follow them at a previous firm, and I believe their core office doesn't have that many employees, and they're just kind of acquiring companies and looking for opportunities. And it's they've done a remarkable job of making that transition towards more capital light type of businesses, and to that extent, it sort of mimics what's uh, Constellation Software in Canada. Just they're acquiring these cash flow businesses and discounting those cash flows back to the future. That creates the value. And so I think that's what Roper's secret sauce was they just focused on the right areas of the market, created a lot of value, and they deserve all the credit. Brian Jellison created a great business.
Strong price discipline as well in the acquisitions.
Yes, yeah, they have very strong price discipline, and that's what it's all about. It's all about being able to replicate the process and not so much feeling the pressure to acquire just to acquire. They're by taking a long-term approach, by waiting for the right opportunities, similar to us as public market investors. It's all about thinking about value, right? We're not trying to collect a bunch of great businesses. I mean, anybody can go out and just buy a bunch of great businesses, but that's collecting, that's not investing. And I think that's what the mark of a great acquirer is as well, is they're looking for value. I mean, they may have wanted to buy this higher quality company to of that for more money, but they just couldn't justify the price at that time. But as we know in public markets too, over certain points of the cycle, those opportunities become more present. So it's all about having the financial strength to make those acquisitions and the discipline when the opportunities come up.
And on acquisitions, I found it so interesting in the Danaher chapter that the CFO, Dan Comas, always found that sellers hadn't told the whole truth in the diligence phase, and that he made a point in asking, now that the deal is closed, please tell us everything you failed to tell us during diligence. And I just thought that really resembles the Berkshire formula of asking for the bad news first. Apart from that example, what do we learn about risk management in the book?
Yeah, that's a good question. I also liked that approach that Danaher asking afterwards, because I do think it talks about um, understanding that making an acquisition is sort of a dance, right? Both parties know that they're not telling, they have cards up their sleeve or whatever it might be, but it's saying, okay, it's done. Let's put that behavior behind us, and let's figure out what's really going on. It's like buying a house, right? And that's something I'd love to do next time I buy a house. Hopefully I don't have to buy a house anytime soon, but just asking the seller after the deal's signed, okay, what do I need to know? Like, where's the water coming in the basement? Those type of things that the inspector might have missed. I mean, those are, that is risk management too, because I'd much rather know that up front and deal with it than be surprised. And as we know, that's what real risk is the things that we hadn't fully thought about. And to the extent that you can know those things, that reduces your risk. And so I think just that question alone is a great risk mitigating type of question to ask. And I think that's really what it's all about, is in the systems as well, is trying to figure out what could go wrong at any point. I haven't done a lot of, it's been a long time since I did any sort of Six Sigma or lean processes at work. We did it back at Vanguard, but I remember that process, and it's very, very formulaic, and thinking about all the things that could go wrong. And especially when you're dealing with manufacturing, just one piece breaking creates a ripple effect across the whole system. And so I think that's also what the systems do, is try to identify as many possible risk events as they can. before they actually start producing.
I think it also makes the point. I mean, we sit there as investors and analysts, and we often don't really see the details happening in a company. I think it was an example also from Danaher that even though they have these great business systems, things I mean happens all the time. They have challenges every day. I mean things break down and so on. It's just about handling all those things in a good way. And I just think that, I mean, it's something that investors needs to think about, that it's not this I mean object that is just static and you get the numbers every quarter and so on. You look at them. I mean, it's good to get that perspective that really things, a lot of things happens in a company, and it's about really the people in the company to handle all the problems in a good way. That's sort of a key thing.
Yeah, I think that's right. I think that's why it's so helpful to the extent that you can get to know the character of the people in the business. It's so much easier to invest when you can go to bed at night knowing that the people who are running the business, the people who are on the front line, are thinking about ways that they can improve the business and create value. You know, I I've invested in the past. Some of my mistakes have been investing in CEOs and leadership teams where there were warning signs of poor character and just kind of a toxic internal environment. And that's something I really want to avoid going forward. Is when I just wrote a piece for Flyover Stocks about this, talking about there's another book you should probably profile at some point called Seven Signs of Ethical Collapse by Marianne Jennings, and it's a great book talking about how it was written in 2006 after the all Enron and WorldCom and some of those failures of the early 2000s, and she really nails a couple of the points that there were many common threads that showed up across these corrupt companies. And it's important to be aware of it, not because you think that they're going to be the next Enron, but it could also lead to terrible decision making, such as making a bad acquisition, trying to make a transformative acquisition, or shuffling segments to hide things that are going on. And that all leads to moat erosion, which leads to declining returns on invested capital, which leads to lower multiples and a poor stock price. So I think these are all important things, is trying to understand the management team's character, how they think about stewardship. Is it just, are they just speaking about it, or are they really living it? And to the extent that you can do that and dig into the company, that's great. And one of the things people always ask, as an individual investor, how can I begin to do this? And honestly, now is the best time than ever before for learning about these things. I mean, podcasts, just if you go on Spotify or go on Apple Podcasts or YouTube, type in the CEO, type in the CFO, type in different people's names in the executive team. Odds are at least one of them has had an interview. Look at local business journals. There's so many ways that you can find these under the radar sources of information about the character of the team. One of the companies I just profiled for Flyover Stocks was Grocery Outlet, and there I found there's a whole a whole series of it's a podcast with 20 episodes or so with independent owners of the grocery stores in the Grocery Outlet chain, and they interviewed two of the managers, two of the management team members in different episodes. And so it's being able to hear both on the ground and in the executive suite perspectives was tremendously valuable to me for someone who had never researched a company before. I have not spoken with investor relations. I do not know the management team personally, but I can pick up from these conversations that there's something positive happening there. It's not it's not a sort of corrupt environment, or doesn't seem to be, or so that risk is, to me, quite low. And that's just from doing some searching on Spotify and local business journals. It wasn't anything sort of going and doing like channel checks or anything like that. It was just going and listening and going for a walk and hearing what management had to say. So there's a lot of things you can do today to begin to pick up on that. But I think it's just, you have to, over time, you start to learn patterns. I think, which can be helpful and sometimes it can't be, but I'd say it's generally helpful to have the sort of patterns that you want to see, some virtuous signals. You can never know for sure, but it definitely helps to have those patterns in place, and you start to figure out which management teams are saying the right things and which ones are not.
I think this is a great point, and one of the examples from the book that comes to mind. I mean, speaking about character is the insane perks that Immelt at GE had. I mean, he, for example, and the authors of the book, they really have close connections to these great leaders. I mean, they have met them many times, and also other members of their teams. And when he interviewed him at some point, then he got to know that the CEO had a team who was flying down his fitness equipment and sets it up in the hotel room. I mean, that really gives you the chills.
Yeah, there's signs like that I think you should be on the lookout for. One of the companies, I won't say which one, but that we covered at Morningstar, not me personally, but someone else. And they went to visit the company, and there was a separate elevator for the executive team. They weren't shoulder to shoulder with the people who were coming to do work. And that to me was just, that's a sign. It's not a good business. I'll leave it at that. But I think that's a very good sign of something that you want to look out for is, how does management work with the frontline employees? Or do they consider themselves separate entities, or do they consider themselves, shoulder to shoulder, servant leaders? I think that's a really key thing. When I worked at Morningstar, Joe Mansueto, who was the founder of Morningstar, he's a tremendous entrepreneur. His desk was just like everybody else's. There was no corner office with glass and closed windows. He sat in a open cubicle system like the rest of us did. And to me, that really spoke to his accessibility and his eagerness to hear from just employees getting a cup of water, at the station. That's the type of leadership that you want to see in the companies. But those are things that just take time to learn, and over time you get to learn some of these things from speaking with other investors and other employees and doing expert interviews or whatever it might be.
And if you can't, I mean, everyone can't visit the headquarters, but the AGM is open. And if it's not too far from you to travel, I definitely suggest everyone to go. I mean, we always try to visit the ones that we are following the companies and where they are reasonably close, because that's there you can talk to other people than just the CEO. You can talk to M&A managers and so on. So that's another interesting area to talk to.
Yeah, investor days are great if you can get an invite as well. Certainly as a individual investor, you're more likely to get in on a smaller cap than you would a larger cap because they have limited space or whatever it might be. But there's a lot of ways that you can do it, and the AGM, I believe, should be open to everybody. What if you have 10 shares or 10,000? So that's another way to do it. But yeah, I think to the extent that you can get to meet different people in the organization, not just the CEO, not just the CFO, that really helps as well. Because the CEO, we all know that they get to that position by being great advertisers and marketers of the business. And so, when you hear them on conference calls and such, they're polished. They're the most polished people at the company. And so you have to always keep that in mind when you're talking with a CEO, that these guys are great marketers, and you have to be aware of that. I mean, I think a lot of them are genuine, but I think that you also have to keep in the back of your mind that they are painting a picture for you, right?
And I think we discussed this before. I mean, one thing of investing is, of course, finding these red flags that makes you avoid a company. But I mean, being an investor such as you, focusing on these high quality companies, it's more often about, I mean, small problems that compound than these big red flags. And those small problems, I mean, small detriments down more or less is really hard for us as humans to grasp in the right way. I mean, how do you think about that in your investing? In your investing process, to find these smaller problems that gets worse and worse. I mean, how do you incorporate that into maybe taking a decision that, I mean, this company is not as high quality anymore, I should sell it?
Yeah, I think position sizing is a great tool that I don't believe is utilized as well as it should be by most investors, including myself. You know, you can own a business that you like, but as there's yellow flags, you can scale it back. Because that's basically what we're doing. And I hate using the analogy of gambling with investing because they're not the same thing. But it's all about playing. If let's say you have 100 chips to play on 20 different hands of poker, here's how would you allocate them? You would put the most behind the most likely positive outcome and the biggest payoff. And so over time, as the odds of that success in your mind change, you can change the bets. It's a never ending bet cycle, right? You can always move your chips to different hands that you think are best positioned to create value longer term. And so if yellow flags begin to present themselves, if those little things start to manifest and you're not quite sure, is this temporary or is it permanent, you can take some off the table. And that's certainly a reasonable thing to do. And whether that's stocks become overvalued or you start to see new competitive threats or you start to see some of these yellow flags, you can resize your bets. Buffett talks a lot about how a moat is something that's created every single day. It can either get wider or narrower every day. And as public market investors, we can't see that every day. We're not in the company. And even people who are on the boards of directors at these companies don't always see that on a day-to-day basis. They might catch it after a quarter. And so as investors, as outside investors, we're lucky if we can pick up on things every 6 to 12 months, something that might be of concern to us. And so one of the tools at our disposal is position sizing. So again, like if you continue to like the company, but you have concerns, you can size up and down that bet over time.
And I think this question is quite interesting. I mean, you've followed so many companies, both from your Morningstar career and also as an investor. I mean, if you could add one chapter to the book, which company would it be about and why?
Yeah, I think the authors did a great job of covering the most important industrials. I would say that one company that should be studied, and it's probably more applicable to today's tech companies because it's more intangible asset based, is Procter and Gamble. Because that Procter and Gamble has been a titan for generations, it seems, and it continues to be one of the largest companies in the United States. And going back to its history, as being in Cincinnati on the canals and being able to sell its wares coast to coast and to different countries, you know, it has this long track record of creating tremendous value. And uh, one of its core differentiators is that it's really stuck by understanding the customer obsession. And there have been dark periods in Procter and Gamble's history, especially over the past 50 years. There have been challenges. There have been activist challenges, but they've really focused on innovating and creating products that really make people's lives easier. And ultimately, that's why they remain relevant. Think about Tide Pods and Swiffers and different things that make people's lives just a little bit easier. And they've got tremendous customer research. It's all about innovation and focusing on brands. That's something that various investors have questioned whether or not brands can be a moat, but I really think that they are. Certainly we've seen that over years. Morgan Housel in his new book has a great story to start his book about how there was a businessman traveling with Warren Buffett around Omaha in 2009, right in the thick of the financial crisis and the aftermath. And he asks, he says to Warren Buffett, why, how are we going to get out of this? Everything looks so bad right now. And Warren Buffett turned to him and said, do you know what the best selling candy bar was? And I think it was like 1928 or something. He said, Snickers. Guess what the best selling candy bar was last year? Snickers. So there's value in these brands, and I think it's certainly hard to quantify what is behind that moat, and I think that's why brands are so often questioned as moat sources. Maybe they're disguising as something else, like distribution benefits or something like that. But I do think there are certainly search cost advantages related to it. If I'm going to the candy store and I've never heard of half of them, but I see Snickers, I know what Snickers is going to be, and it's a satisfying decision making process. That's the familiarity. Like I know exactly the dosage of chocolate and the taste. I know exactly what I'm going to get. And that's why Starbucks and Chipotle and all these different brands resonate so well with customers over time. And Procter and Gamble has certainly picked up on that. Some of their brands have been around for generations. And if you're someone who creates a new household and you never had to buy laundry detergent before, like, you're not going to go comparing laundry detergents, and you're going to go with what your mom and dad used or something you're familiar with, and usually that's Tide. And that's just how these brands continue over time. And I've been a Nintendo investor for a couple of years, and just thinking about the nostalgia effect related to the Nintendo brands and how that kind of creates a multi-generational benefit for the company. These are really important assets. And so Procter and Gamble has certainly gotten that right. They've also, similar to the industrial companies, they've reduced a lot of organizational bureaucracy. They undergo changes every couple of years through their structure, and that seems to help with the creative process and create value and reduce bureaucracy in the business. So it's been an incredible testament to the business to survive and thrive despite having seemingly persistently high expectations from the market.
And the name of Morgan House's new book is Same as Ever.
Yeah, it's a great read. I'm like halfway through. Morgan's a great writer, of course, and so it's a pretty quick read.
Definitely. And speaking about something that is new, is your new endeavor, Flyover Stocks, the newsletter. Please tell us a bit more about what you're doing.
Yeah, so at Flyover Stocks, we're looking for companies with economic moats that are led by thoughtful stewards of shareholder capital and are ideally trading for an attractive price. And when I was at Morningstar, I did a series of articles called Seeking Small Cap Moats. And these were monthly picks. They weren't picks, they were more like profiles of different companies that I thought had economic moats by the Morningstar definition, but we didn't actively cover at Morningstar. And having been able to look back on those over 10 years now, start to see that there are some pretty attractive businesses that were profiled. Badger Meter, Winmark, Exponent, these were all well over 400% returns over the 10-year period. And I thought, well, maybe there's something to continue to look at there. Trying to find these companies that may not resonate or jump off the page at an investor who's never heard of the company before. Trying to find, like for example, Badger Meter sounds like a ridiculous name, right? And so that they do water metering, and it's a very bland business. It's got a kind of funny name, and they're based in the Midwest. And people aren't going to be making a lot of trips from New York to come out and take a look around. And I think it flies under the radar and becomes a great business. And those are the sort of businesses that I'm attracted to, or companies with funny names and are in strange places that are well off the beaten path. Jack Henry and Associates is one of the best performing stocks over the past 25, 30 years. And they do banking software for small banks and credit unions. And they're based in Monette, Missouri, which is population 10,000. And those are just really fascinating businesses to me that I think deserve profiles and to be shared with other investors. And that's really what I'm looking for. And then so I do a monthly profile of a company, and I also write commentaries about investing in between the company profiles.
And is the service free, or how have you set that up?
Sure. So the service is both free and paid. So most of the commentaries are, so these are just kind of evergreen investing lessons, and the company profiles have been moved to paid. But if you're a free subscriber, you still get the business description, but I leave the moat management, risk and opportunities, and valuation analysis for the paid subscribers. And so the reports are typically 3,000 to 4,000 words.
And how are you structuring your days now? A lot of writing and researching?
Yeah, a lot of writing and researching, and just it's been great to sort of have the freedom to pursue the different companies that I wouldn't have been able to look at in previous roles, just because of the investment mandates and the universe that we were focused on. So having just carte blanche and being able to look wherever I find interesting has been very refreshing and energizing to be as an investor.
What would you say is the biggest difference between like the larger names that you looked at Ensemble, for example, with the smaller names that you look at now?
Well, I think it's the key difference is I would say moat size. So, or moat width, if you will. A lot of the large cap companies that we looked at in my previous job, they were these dominant companies in their spaces. And most small companies, small and mid cap size companies, if they have a moat, that's great. But it's usually pretty narrow, and you can always come up with an alternative explanation as to why it won't work, or maybe why a larger company could come after it. And so I like to find these companies that are in the kind of the SMID cap space that have some sort of barrier to entry that make it difficult for smaller upstart competitors to compete with them on scale, and but aren't these huge opportunities that will attract investment dollars from the large cap companies. So those are really nice spaces to be in. One of the companies that I profiled, which is free. There's two free reports that are full reports on my site. They're about Worthington Industries and Howden's Joinery in the UK. And Worthington is going to be spun. There's a spinoff happening where the steel part of the business is being spun off, and they're keeping some of their building materials, building products JVs, and their pressurized cylinders for consumers. And those are businesses where they're very profitable, but they're not jumping off the page at you as 80% returns on invested capital and growing 20% a year, and which would attract certainly investment from larger companies. But they find these niches that are flying under the radar but are still very profitable and should continue to create great shareholder value, in my opinion.
And how is the portfolio structured?
The Flyover stocks does not have a portfolio per se. It's just sort of profiling these companies. But my personal portfolio is about 20 companies, and I keep an eye on them pretty regularly. And I think that's pretty good bit of diversification to have. I think the data show that if you have fewer, you have a better chance of outperforming. But if you have more, you have less chance of outperforming. But there's sort of a trade-off where if you outperform with, let's say, 5 to 10 stocks, that's great, but you can also lose a lot too. And if you have too many, you don't have any chance of outperforming. So you might as well index. And so I try to find this sort of sweet spot, which I think is about 15 to 20 companies, where you still have some benefits of active management, but you also have diversification where you're unlikely to really underperform for a very long time.
And are those mostly in the US?
Mostly US. I do have a few international companies. I mentioned Admiral Group before. I also own Games Workshop in the UK, and I also own some shares of Howden's Joinery, which I bought a couple weeks after I profiled them on Flyover stocks.
And this being a book podcast, besides Lessons from the Titans, do you have one or two other books that you think more investors should be reading?
That's a great question. I just shared my bookshelf on Twitter. I have a link to it on my personal website, and so if you want the full list of my bookshelf and some of my favorites, those are there. I think that pretty much every investor should read Common Stocks and Uncommon Profits by Philip Fisher. I think his work in particular speaks more to today's type of investing than some others from that era, which were more tangible asset focused. I mean, we've certainly shifted into a more intangible asset economy, globally speaking. And certainly in the US, a lot of the leading companies are more intangible based. And Philip Fisher wrote the book 70 years ago. I mean, it's 60 years ago. It's still very, very relevant to today. And so I think everybody should read that book. Another one I would recommend that most people haven't looked at is Joel Tillinghast's Big Money Thinks Small. And he was a legendary Fidelity investor who did the Fidelity Low Price Stock Fund, I believe, for well over a decade, had great performance. There's a foreword by Peter Lynch. Along the same lines, there's a book, I think it's called Investing Against the Tide by Anthony Bolton in the UK, who is a legendary investor who most people do not know about, and in the US at least. and he was also from Fidelity, and Peter Lynch also wrote a foreword for that one. So these are all great. Those are all sort of foundational reads, in my opinion, that people should have on their bookshelf.
We'll put those in the show notes. And will there be a book, another book written by you? You have written one book.
Yeah, I wrote Keeping Your Dividend Edge in 2016. That was inspired by my time at Motley Fool, where I focused on dividend investing. I had a lot of readers from that newsletter who continued to reach out asking for my thoughts on dividend investing. And so I wanted to kind of write a capstone to my dividend investing approach and how I think about dividends. And that book serves that purpose. So it covers all the bases from how to find dividends to dividend paying stocks, to avoiding risks, to portfolio management of a dividend focused portfolio. I'd love to write another book. It just really comes down to finding the topic that I think would resonate with a lot of folks, and trying to find a publisher who would be willing to do it. My first book was self-published, and that's something that with hindsight, I wish I had gone a different route, but it was a good lesson regardless, that writing a book and publishing a book and editing a book is really hard work, and you really need to find a great publisher to team with. And certainly if the opportunity came up and I had something I wanted to write about, would love to.
Todd Wenning, thank you so much for coming on Investing by the Books podcast and sharing your thoughts on how we can improve as investors. Do you have something more you want to add before we finish up here?
No, thanks so much for having me. I think the key thing I would leave folks with from Remember the Titans is really look at that Dave Coates story. I think that's something that you should really take to heart, and really try to find those great stewards of the business, and that will greatly reduce your risk, I think, as an investor over the long term, and focus on those types of businesses.
Great. And lastly, where can our audience? I mean, we know that we can follow you on Flyover stocks, but do you have are you active on Twitter or other sources?
Sure. You can find me on Twitter or on Threads at Todd Wenning. It's just my name. And my messages are open, so you're always welcome to send me a note.
Perfect. Thank you so much.
Thank you for having me.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.